Imagine this. Your company has cash tied up, just sitting idly with the IRS money that could be powering your next big project, maybe helping you acquire a competitor, or simply navigating unexpected challenges. What if there was a way to get a significant chunk of that money back, and quickly, without waiting months for your annual tax return to process? For corporations, that's not just a fantasy, it's actually a strategic reality, but one that often gets overlooked. Welcome to the Deep Dive. Today, we're cutting straight to the chase and uh, plunging into a specific IRS form that offers a really powerful solution for corporate cash flow. Form 4466. We're going to unpack who can use it, the critical deadlines, exactly how it works, and maybe most importantly, why understanding this seemingly small piece of paper can make a huge difference in your company's financial agility. Our mission today is basically to transform a pretty dense tax document into clear, actionable insight for you, hopefully helping you uncover potential financial leverage you might not even realize you have.
Yeah, it's truly a fascinating area because, on the surface, it looks like just another IRS form, another piece of bureaucracy. But when you really dig into its implications, you start seeing it as this powerful lever for financial optimization, especially for businesses that experience, let's say, significant fluctuations in their profitability or maybe anticipate substantial changes in their tax liabilities throughout the year. It's really about more than just getting a refund. It's about timing, liquidity, and strategic capital deployment.
Timing and liquidity, yeah, two incredibly crucial elements for any business aiming for agility, especially in today's, well, fast-paced economic environment. So let's start with the basic problem this form aims to solve: the corporate conundrum of estimated tax payments. For those of us who aren't, steeped in corporate tax law every single day, can you give us the quick rundown? Why do corporations even pay estimated taxes in the first place? It seems simpler just to pay it all at the end of the year.
Well, that's a common thought, but the basic idea behind corporate estimated tax payments is actually quite logical, both from the government's perspective and the corporations. The IRS basically wants to ensure that corporations pay their income taxes throughout the year, more or less as they earn the income. They don't want everyone waiting until the end of the tax year to pay one, massive lump sum. This system helps the government maintain a steadier revenue stream for its operations.
Right, steady cash flow for Uncle Sam. Makes
Yeah,
sense.
exactly. And from the corporation side, it prevents them from facing this overwhelming, maybe even potentially crippling tax bill all at once on the filing deadline. Think of it kind of like how individuals have income tax withheld from their paychecks, right?
Yeah.
Or make quarterly estimated payments if they're self-employed. For corporations, these payments are typically made in 4 quarterly installments, and they're based on their projected income for the year.
Okay, that makes perfect sense. It's about aligning the tax payments with when the income is actually earned. Sounds fair enough. But for dynamic businesses, trying to predict future income and your precise tax liability, that sounds like trying to hit a moving target. What are some of the biggest challenges companies face in getting those estimated payments exactly right?
Oh, it's an enormous challenge. I mean, businesses operate in environments that are constantly shifting, often really unpredictably. Market demand can swing rapidly. Global supply chains can get disrupted practically overnight. Unforeseen operating expenses can suddenly pop up. Or maybe a new product launch performs vastly different. Could be better, could be worse than the initial projections. All these things directly impact revenue and, crucially, profitability. So when you're trying to forecast these variables, sometimes a full year in advance to figure out your estimated payments, well, it's truly a high-stakes guessing game. Often the initial estimates are based on, say, prior year performance or maybe optimistic early year projections, which can become outdated pretty quickly.
And that leads directly to what you called the overpayment problem. It sounds like it's surprisingly common for corporations to find they've paid too much estimated tax. What are some of the most frequent reasons this happens in the real world? Can you give us some concrete scenarios?
Oh, it happens more often than you might think. One primary reason is just an unexpected dip in revenue or profits. Imagine like a retail chain. Maybe they had a really strong holiday season at the end of their prior fiscal year, which leads to pretty robust early year estimates. But then maybe consumer spending slows down significantly in the second or third quarter because of an economic downturn, or perhaps new competition enters their market. Their actual profits end up being far lower than they anticipated, but they've already made substantial quarterly payments based on those early numbers.
So they're locked into payments based on outdated good news.
Exactly. Another big one is large unforeseen deductions or tax credits. Maybe a tech startup makes really aggressive R&D investments mid-year that qualify for significant research and development tax credits they hadn't fully factored into their initial estimated payments. Or maybe a manufacturing company makes a major capital investment, like buying new machinery, which then qualifies for accelerated depreciation deductions. These kinds of deductions can drastically reduce their taxable income, turning what seemed like an accurate estimated payment into a substantial overpayment.
Right. So they might have accounted for their usual operational deductions, but then something significant and maybe unplanned comes along, changing the whole tax picture midstream.
Precisely. And sometimes, too, businesses just make conservative initial estimates. They err heavily on the side of caution to avoid underpayment penalties, which can be quite steep. So they might project higher profits or fewer deductions than ultimately materialize. This is a common strategy, actually, especially for newer businesses or maybe those in really volatile industries. And of course, broader market fluctuations can impact profitability across an entire industry. A sudden global event, a shift in commodity prices, a change in consumer sentiment, all these can lead to a company-wide overestimation of income and consequently overpaid taxes.
And the consequence of all this overpayment. Your cash, which could be doing so much for your business, is essentially locked up with the government. It's just sitting there, basically an interest-free loan to the IRS, right? Which reduces your working capital and stifles your investment potential. This isn't just a theoretical loss, is it? It has real tangible impacts.
Oh, absolutely not theoretical. That cash is illiquid. It's tied up. It's not earning interest for you in your business accounts, and it's certainly not available for critical business needs. This could mean, delaying a crucial software upgrade, maybe missing out on a timely opportunity to acquire a smaller competitor, or even needing to take out a short-term, maybe a high-interest loan to cover operational expenses or payroll simply because your own capital is inaccessible. It ties up really valuable resources that could otherwise be deployed for growth, for innovation, or just building a stronger financial cushion. In a tight economy, efficient cash flow management can literally be the difference between seizing an opportunity and struggling to stay afloat.
Okay, this is precisely where Form 4466 steps in. And it sounds like a genuine game changer for many businesses. It's officially called the Corporation Application for Quick Refund of Overpayment of Estimated Tax. What's its core purpose, and why is quick the key word here? What makes it different from just waiting for your regular tax refund?
Well, its core purpose is exactly what the title says. It allows eligible corporations to get a refund of overpaid estimated taxes before their final annual tax return is even filed and processed by the IRS. Normally, you'd wait until you complete and submit your Form 1120 or whatever your annual return is, and then you typically wait for months, sometimes 4 to 6 months, maybe even longer, for the IRS to process it and issue any refund. Form 4466 effectively short circuits that entire lengthy process. It's designed specifically to provide a rapid return of capital.
So it's like a fast-track lane at the bank when you realize you've accidentally overpaid a major bill.
Yeah.
It lets you recover your funds much, much sooner than the standard slow process. This effectively converts those illiquid overpayments into immediately accessible cash, significantly enhancing a company's financial flexibility. For businesses constantly managing cash flow, this kind of speed, what's absolutely critical.
That analogy is spot on, actually, for many businesses, particularly those operating with tight margins or maybe planning significant capital expenditures or simply navigating a period of economic uncertainty. Having access to these funds quickly can make a really substantial difference. It empowers them to operate more smoothly, capitalize on time-sensitive opportunities, or respond to unforeseen challenges without, depleting reserves or resorting to expensive external financing. It truly is a strategic cash flow management tool. It transforms a passive overpayment into an active asset.
That leads us perfectly into our next section. Who exactly is eligible to file this powerful form? And what are the key thresholds that sort of act as gatekeepers to this quick refund? It sounds like it's not for every single little overpayment.
You're right, it's not. At its broadest level, any corporation that has overpaid its estimated tax for the tax year may apply for a quick refund. However, and this is key, there are very specific conditions that must be met for that eligibility to translate into an actual refund. These are what we call the dual eligibility criteria, and you absolutely have to satisfy both.
Okay, so it's not just any overpayment. What are these two crucial conditions that really define if you can use Form 4466?
Right. There are two main gates you have to pass through. The first is what the IRS calls the 10% rule. This means the overpayment must be at least 10% of the expected tax liability. This basically ensures that the amount in question is substantial enough relative to your total tax burden to actually warrant this expedited process. The IRS isn't going to quick refund a tiny discrepancy that costs them more in admin time than the refund itself. It needs to be a meaningful percentage of your overall tax picture.
So it needs to be a material overpayment, not just a rounding error, for the IRS to bother processing it quickly. Makes sense. And the second condition.
The second one is the $500 threshold. The overpayment must also be at least $500. This sets a minimum absolute dollar amount. Again, it's about administrative efficiency. The IRS isn't going to process a quick refund application for an overpayment of, say, $50, even if that $50 technically represents 10% of a very small expected tax liability. It needs to be a meaningful amount in absolute terms that justifies the administrative effort for both the corporation and the IRS. And remember, both of these conditions, the 10% rule and the $500 threshold, must be met simultaneously. If you meet one but not the other, you're not eligible for Form 4466.
So that makes it very clear. So how is this overpayment actually defined for the purpose of these calculations? Because you're filing this before your final tax return, so it has to be based on an estimate, right? What exactly are you estimating?
Exactly. The overpayment is specifically defined as, let me get this right, the excess of the estimated income tax a corporation paid during the tax year over the final income tax liability expected for the tax year at the time this application is filed. The key phrase there is expected for the tax year. This means you're not just looking at what you've paid so far. You're proactively determining your current best estimate of your actual total tax bill for the entire year. And this estimate is based on your financial performance right up to the point you file Form 4466. It requires foresight, accurate financial modeling, and usually close collaboration with your internal finance team or maybe your external tax advisors. It's all about projecting your likely year-end tax position using the best information you have available right now.
That proactive element is really important. It definitely pushes companies to have a clearer, more real-time view of their financial standing. Now, what about special cases, like affiliated groups of corporations or those filing consolidated returns? How does Form 4466 apply to them? Their structures can get pretty complex.
Yeah, this is where it can get a bit nuanced, and it's really important to pay close attention to the details in the instructions. If an affiliated group of corporations paid their estimated income tax on a consolidated basis, meaning, they filed one set of payments for the entire group, or if they expect to file a consolidated return for the tax year, then only the common parent corporation may file Form 4466. This makes sense, right? It reflects the centralized financial management and tax strategy that typically happens within consolidated groups. The parent company acts on behalf of the entire group for this quick refund, which streamlines the process.
So the parent company is basically the single point of contact for the quick refund for the whole group. Okay. But what if, say, a subsidiary or a member of that group wasn't part of the consolidated picture for the entire tax year? Maybe it was acquired mid-year, or it operated as a standalone entity for part of the period.
That's an excellent point, and the instructions specifically address it to make sure the refunds go to the right place. If any member of the group paid estimated income tax during a portion of the tax year when it was not a member of the consolidated group, say, a company was acquired in June and they made their January and April estimated payments as a standalone entity, then that individual member, not the common parent, must file its own Form 4466 for those specific overpayments made during its standalone period. This ensures the refund goes back to the specific legal entity that actually made the payment when it was operating independently. It's really crucial for maintaining accurate records and proper financial flow within complex corporate structures, preventing, commingling of funds from different tax periods or different corporate statuses.
That makes perfect sense. It ensures the refund goes back to the entity that actually made the overpayment while it was independent. Now, there's a crucial little note about Form 4466 that I bet often gets overlooked. It says Form 4466 is not considered a claim for credit or refund. Why is that distinction important? What does it tell us about the nature of this form?
Yeah, that note is incredibly important because it clarifies that Form 4466 isn't your standard refund claim, like the one you'd make when you file your annual tax return on, say, Form 1120. A regular refund claim typically triggers a more comprehensive review or reconciliation of your entire tax liability for the year. Form 4466, by contrast, is a specific expedited process designed only for quick access to overpaid estimated taxes. It's not meant to initiate a full audit or a deep review of your overall tax situation. It's about getting back cash you've clearly overpaid based on your current best estimate. It's really a mechanism for liquidity, not a general petition for money back or a final determination of your tax liability. It signals that this is a streamlined, purpose-built channel focused purely on cash flow management, emphasizing speed over a full tax review.
That's a key distinction. It's all about speed and efficiency for a very specific type of overpayment. Which brings us nicely to our next critical segment, mastering the timing in the process for Form 4466. Because with these IRS things, timing is usually everything if you want those funds when you need them.
Indeed it is. There's a very specific filing window for Form 4466. And if you miss it, well, you miss out entirely on the quick refund mechanism. You have to file Form 466 after the end of the corporation's tax year. This is logical, right? You need to have completed the tax year and made all your estimated payments to accurately figure out if there's an overpayment. You can't file it mid-year based on projections. It's strictly a post-year-end, pre-final return tool.
Okay, so once your tax year closes, the clock starts ticking, and you can begin preparing this form. But there's a hard deadline on the other end, right? A point of no return for this quick refund option.
Yes, absolutely. And this is absolutely critical. You must file it no later than the due date for filing the corporation's tax return, not including extensions.
Mm.
Okay. This is a really common trap for corporations, and it catches a lot of people off guard. For most calendar year filers, that original due date is April 15th. This means even if you get an extension for your final tax return, say you push your 1120 filing out to October, that extension does not extend the time for filing Form 4466. The window for the quick refund stays tied to the original unextended due date.
Wow. Okay, that's a huge warning for financial planners then. You might think, oh, I've got 6 more months to file my 1120, so I have more time to sort out this quick refund thing. But you absolutely do not. It's like a separate parallel deadline you cannot miss.
Exactly. The IRS is crystal clear on this point. An extension of time to file the corporation's tax return will not extend the time for filing Form 4466. And the logic is, Form 4466 relies on your estimated liability, which is only relevant before your final actual liability is determined and your official return is filed. Once you've filed your official income tax return, like the 1120, the quick refund mechanism is no longer applicable. Any refund would then have to be processed through the standard, much slower channels as part of your overall return processing. So if you're planning to file an extension for your main return, make absolutely sure Form 4466 is already filed and out the door before that original deadline passes.
So it's a narrow, non-negotiable window, and you have to be precise. Now, once you've got your estimates sorted out and you're within that window, how do you actually file it? What are the practical steps, and what kind of attention to detail is required?
Okay, first and foremost, you need to complete and file an original signed Form 4466. The emphasis here is definitely on accuracy and the signature. You are signing this application under penalties of perjury, which means you're legally attesting to the truthfulness and completeness of the information you're providing. This isn't just some casual document. Any material omissions or significant errors can, and often do, lead to disallowance, as the IRS instructions clearly state. So you really need to triple check your numbers.
And where does it actually go? I assume you don't just send it to any old IRS office. There must be a specific address.
That's correct. It needs to be filed with the applicable and Internal Revenue Service Center. And the specific address depends on the type of annual return your corporation will eventually file. For example, most standard corporations filing Forms 1120, 1120C for cooperatives, 1120H for homeowners associations, and various insurance company forms like 1120L, 1120PC, or 1120SF, regardless of their total assets, will typically send it to the Internal Revenue Service Center in Ogden, Utah, specifically Ogden UT 84201. Now, if you're a foreign corporation filing Form 1120F or 1120FSC, or maybe your principal business is located in a foreign country or a U.S. possession, it generally goes to a specific P.O. box, also in Ogden, Utah, P.O. Box 4091001, Ogden UT 84409. Getting the address right is absolutely paramount to avoid delays or even having it rejected because it was misdelivered. Don't just guess, look it up carefully in the form instructions.
Okay, so rule number 1, check the instructions for the precise address that matches your specific corporate entity type. Now, for the exciting part, maybe, once it's filed and in the mail, how long does the corporation typically have to wait? Is there an actual IRS commitment, or is it just a sort of, we'll get to it when we get to it situation?
This is one of the most significant advantages of using this form. The IRS will act on Form 4466 within 45 days from the date it is filed. This is a relatively short, fixed time frame for receiving the funds, which provides incredible certainty and really enhances financial planning. Think about that, 45 days. Compared to the months it can sometimes take for a standard refund after your full return is processed, this specific commitment from the IRS is pretty rare and quite powerful. It actually allows your finance team to plan for that cash infusion with some confidence.
45 days. Yeah, that can make a huge difference in a company's cash flow, especially when managing working capital or trying to make time-sensitive investments. It's a real, tangible benefit. What else needs to be done with Form 4466 once you eventually file your annual income tax return, even after you've hopefully received your quick refund?
Right, even after you've sent in the original Form 4466 for the quick refund and maybe you've already received the funds, you must also file Form 4466 with its income tax return. You actually have two options here. You can either attach the original signed Form 4466 to your final tax return, like your Form 1120, or alternatively, you can attach an unsigned copy that has the exact same information, but then you must retain the original signed Form 4466 in its records. This just ensures that when the IRS processes your final annual return, they have a clear record of the quick refund application and can easily reconcile it with your actual final tax liability. It's part of their internal audit trail and just crucial for proper compliance. So, a necessary record-keeping step. Important for internal compliance and for the IRS to connect the dots later. And finally, on the how-to file front, you mentioned accuracy being key. What happens if there are errors or material omissions? What if a company gets a bit careless with its estimations?
Yeah, the IRS clearly states that any application that contains material omissions or errors that cannot be corrected within the 45-day period may be disallowed.
Mm.
This really underscores the paramount importance of accuracy and completeness. You absolutely don't want to jeopardize your quick refund by rushing through the form, making careless math mistakes, or providing incomplete information, because trying to correct those mistakes might take you past that critical 45-day processing window, which could lead to the whole application being disallowed. And if it's disallowed, well, you're pushed back into the regular, much slower refund process, effectively losing the entire benefit of using Form 4466 in the first place. So definitely take the time to get it right the first time. Okay, so accuracy, timing, proper filing, all absolutely paramount. Now let's dig into the form itself. It looks like, any other IRS form at first glance, but can you walk us through its structure and the significance of some of its key lines, particularly those involved in calculating that crucial overpayment amount?
Absolutely. When you look at Form 4466, it has that standard IRS layout. Your company's legal name, address, employer identification number, EIN, and the specific tax year you're filing for. There's a really crucial section right at the top where you check type of return to be filed. This is important because it shows just how broadly applicable this form is, well beyond just the standard Form 1120 for C corporations. You see options there for Form 1120C for cooperatives, 1120F for foreign corporations, and even specific forms for different types of insurance companies like 1120L or 1120PC.
And I see there's another box too, which suggests it reaches even further than that, right?
Precisely. The other box is quite specific and covers some less common but still important entities. It's used for S corporations that have made protective estimated tax payments in their very first tax year, which is a niche but important use case for certain new businesses electing S corp status. It also includes corporations filing specialized forms like 1120 FSC for foreign sales corporations, 1120H for homeowners associations, 1120 REIT for real estate investment trusts, 1120 RESE for regulated investment companies, 1120 SF for settlement funds, and even certain tax-exempt organizations filing Form 990T for unrelated business income tax. This breadth really highlights how many different types of entities can potentially benefit from this quick refund mechanism, far beyond just your typical large C Corp.
Wow, that's a lot of different corporate structures that could potentially use this. So once you've identified your type of return, you get down to the actual numbers section. Can you walk us through the most important lines for calculating that eligible overpayment? This is where the rubber meets the road, so to speak.
Right, this is where the core calculation happens, and each line really builds on the previous one. Line 1 asks for estimated income tax paid during the tax year. This is fairly straightforward. It's the total cash your corporation has actually paid in estimated taxes throughout the year. You should have clear records of these payments from your accounting system. Line 2 accounts specifically for any overpayment of intertax from prior year credited to this year's estimated tax. This is for situations where you had an overpayment on your previous year's tax return and you chose to apply that overpayment as a credit toward this current year's estimated taxes instead of getting it back as a refund last year. It acts like an additional payment made for the current year. Line 3 is simply the total. You just add lines 1 and 2. This represents your grand total of all estimated payments and credits that are available to be applied against your current year's tax liability. It's basically the pool of money the IRS currently hold on your behalf for this tax year.
Okay, so line 3 is essentially all the money you've put toward your tax bill so far this year, one way or another. What comes next? And how does that critical expected tax liability figure come into play?
Next is the absolutely crucial line 4. Enter total tax from the appropriate line of your tax return. This is your expected total tax liability for the entire year. It's what you currently anticipate your final tax bill will actually be when you ultimately file your proper income tax return, like, say, Form 1120, Schedule J, line 11. This line is where your accurate, up-to-the-minute financial forecasting really comes into play because it's the cornerstone of proving you've overpaid. This isn't just pulling a number out of thin air. This requires serious, often rigorous financial modeling, and usually a deep dive into your books with your accounting team or advisors. A common mistake here is using outdated projections.
So you're not putting what you did pay on this line, but what you expect your total bill to be for the entire year. You have to be very confident in your current projections. That's a really crucial distinction.
Precisely. Then we have a couple of adjustment lines. Line 5A is for personal holding company tax, if any, and line 5B is for estimated refundable tax credit for federal tax on fuels. These are specific adjustments for certain less common types of taxes or credits that might alter your overall liability. Most corporations probably won't have entries on these lines, but it's important to check if they apply to you. Line 6 is simply the total of those adjustments, lines 5A and 5B. Then, line 7 is your expected income tax liability for the tax year. You get this by subtracting line 6, the adjustments from line 4, your expected total tax. This is your net expected tax bill, the bottom line number against which your payments will be measured. It's your best current estimate of your true tax burden for the year after accounting for any specialized taxes or credits.
And then the moment of truth arrives on line 8, where you actually figure out if you're eligible for this quick refund.
Yes, line 8 is the overpayment of estimated tax. This is calculated simply by subtracting line 7, your net expected liability, from line 3, your total estimated payments and credits. This is the key line for eligibility. And right there on the form, it clearly reiterates the eligibility criteria we discussed earlier. If this amount is at least 10% of line 7 and at least $500, the corporation is eligible for a quick refund. Otherwise, do not file this form. This is where those financial gatekeepers we talked about are numerically applied. If your calculated overpayment on line 8 doesn't meet both of those thresholds, the form explicitly tells you not to bother filing it because you won't be eligible for the quick refund anyway.
It's a very clear yes or no at that point, based strictly on those two thresholds. And I see there's also a record of estimated tax deposits section on the form. Is that just for historical tracking or?
Yeah, it is, primarily. It's basically a place for you to list the dates and amounts of your individual estimated tax deposits made throughout the year. This section really reinforces the need for meticulous financial records and helps ensure that line 1, the total estimated tax paid, is accurate and fully supported by your company's actual payment history. It provides a nice, transparent audit trail for your payments right there on the form.
And finally, there's the signature block. You mentioned it earlier, but it probably bears repeating that signing under penalties of perjury adds a significant legal weight to this application. You're essentially making a sworn statement to the IRS about the accuracy of your expected tax liability and the amount you're claiming back.
Absolutely. It's definitely not just a formality. That signature legally binds the corporation to the accuracy of the information provided. It's a key part of the integrity of the whole tax system. Any intentional misrepresentation or, gross negligence in preparing the form could have really serious consequences, far beyond simply having the refund disallowed. It could potentially lead to additional penalties or even legal action in extreme cases. It really underscores the responsibility that comes with seeking this expedited refund.
Okay, so we've covered the what, the who, the when, and the how of Form 4466 pretty thoroughly. Now let's talk about the real-world impact. What's the powerful upside for businesses that proactively leverage this form? And as with many things in the tax world, what's the potential downside, that excessive refund trap, that they really need to be aware of?
Right. The powerful upside is really all about cash flow empowerment. The primary benefit, as we've kind of hit on throughout, is immediate liquidity. Getting that cash back in hand within roughly 45 days is a genuine game changer for many corporations, especially those in fast-moving industries or maybe facing economic headwinds. This isn't just about reducing your tax bill eventually, it's about optimizing your working capital now and ensuring those funds are deployed where they're most needed much sooner.
Yeah, it's turning a stagnant asset, that money just sitting idly with the government, back into a dynamic one that can actually fuel business activity. What can companies strategically do with that enhanced financial flexibility once those funds are back in their accounts?
Oh, the possibilities are pretty extensive and can be really impactful. Those funds can be immediately reallocated. This might mean bolstering working capital for daily operations, especially if revenues have unexpectedly dipped. For instance, maybe a manufacturing firm that had a strong first half then saw a sudden slowdown due to supply chain issues could use these recovered funds to cover payroll or maintain necessary inventory levels without borrowing. Or it could be used to fund critical, maybe time-sensitive investments, perhaps purchasing new equipment that's available at a temporary discount, accelerating R&D projects to gain a competitive edge, or expanding into new markets or product lines that require significant upfront capital. For some companies, it might simply mean paying down high-interest debt, which immediately improves the company's financial health by reducing interest expense going forward. And crucially, it can bridge unexpected cash flow gaps, potentially preventing the need for costly short-term external financing, like lines of credit or high-interest loans, which can really eat into profitability.
So it's really not just about getting some money back. It's about actively improving your balance sheet, your operational capacity, and maybe even your competitive positioning. It transforms a tax overpayment from just a lawn item into a usable asset.
Precisely. It's fundamentally a matter of financial efficiency. It prevents your corporation from essentially giving an interest-free loan to the government for potentially months on end. By recovering those funds quickly, you improve the effective return on your corporate assets. That money can be earning something for you rather than sitting idle in the Treasury's accounts. And when you compare this 45-day turnaround to a standard refund, which, as we said, can take months to process after you filed your full tax return and really has no fixed timeline, Form 4466 is explicitly designed for speed and tactical financial deployment. That certainty of the 45-day window allows for much more proactive and confident financial planning.
That certainly sounds like a powerful tool that every corporate finance department should probably have in its arsenal, or at least be aware of. But, as with many things in the tax world, especially those offering quick benefits, there's usually a flip side, right? A potential downside.
Yeah.
What is this excessive refund or credit trap that corporations need to be acutely wary of?
Yes, this is a crucial area where that accuracy we stressed earlier truly pays off, and where carelessness can become quite costly. If the quick refund you receive via Form 4466 is later found to be more than what the corporation was actually owed based on its final filed tax return, meaning your initial estimate on Form 4466 was too optimistic, you underestimated your final tax bill. There are definite consequences. This is governed specifically by Internal Revenue Code Section 6655H, which is a part of the tax law dealing with penalties related to underpayment of estimated tax, and it includes this provision for excessive adjustments.
Okay, so if your initial estimate on Form 4466 was too low on the tax liability side, and you got more back than you ultimately deserved based on the final numbers, what exactly is considered the excessive amount that triggers this consequence? Can you give us a clear example, maybe?
Sure, the excessive amount is technically the smaller of two calculated figures, but let's simplify it for clarity. Think of it as basically the difference between the quick refund you received and the amount you actually should have received based on your final accurate tax return. It's the amount you got back too much of too quickly. For example, let's say your company received a $50,000 quick refund through Form 4466 based on your initial estimates. But when your final accurate tax return was filed later, it turned out your actual tax liability was higher than you expected, and you were only truly entitled to a $20,000 refund for the year overall. The excessive amount in this scenario would be $30,000. That's the $50,000 you received minus the $20,000 you were actually owed. This $30,000 is the figure on which the penalty will be based.
And what's the actual consequence of having this excessive amount? Is it just interest you have to pay back, or is it something more punitive?
It's not just an interest charge, it's specifically labeled an addition to tax, which functions essentially as a penalty. The IRS will figure this addition to tax themselves, and they'll bill your corporation for it. You don't calculate it on your return. The calculation period for this penalty runs from the date the refund was paid or credited until the original due date of the corporation's return.
So for every day you had access to that excessive amount of money before your tax return was officially due, the original due date, not the extended one, you're effectively incurring this penalty charge.
So it's basically a penalty for having the use of money you weren't fully entitled to for that specific period between getting the refund and the original tax deadline, almost like a charge for inaccurate forecasting. And the most crucial part here, I imagine, is that this penalty is likely not deductible, is it? You're exactly right, and this is often the most impactful part of this penalty. The addition to tax is not deductible for income tax purposes. This means you cannot use this penalty payment to reduce your future taxable income. It's a direct out-of-pocket cost to your business that cannot be offset in any way, making the penalty significantly more costly than if it were treated as a deductible interest expense. This non-deductibility really underscores just how vital it is to make as accurate an expected tax liability estimate as possible back online for a Form 4466. It's a quick refund, yes, but it absolutely comes with the responsibility of diligent, accurate forecasting. It's a powerful tool, but it definitely demands precision.
That's a critical point for any finance team to remember. This form is a great tool, but it requires diligent and realistic forecasting to avoid a costly, non-deductible penalty. Which leads us perfectly into our final section. Thinking about the strategic application and the broader implications of Form 4466,
Yeah.
sounds like it's really much more than just a compliance checkbox to tick off.
Indeed. Form 4466 isn't just a compliance document or some reactive measure you take when you realize you overpaid. It's truly a financial lever that, when used strategically, can significantly empower a business. It can turn potential liabilities, like locked up cash, into actual opportunities. It really shifts tax management from being just a year-end chore to being part of an ongoing, proactive financial strategy.
So when is it most valuable? What are the specific scenarios or maybe internal triggers where a company should definitely be looking at this, perhaps even making it part of their regular financial review process?
Well, it's particularly valuable for companies experiencing a significant, maybe unexpected, downturn or incurring unexpected losses mid-year, especially after they've already made substantial estimated payments based on earlier, rosier projections. Think about, say, a travel company heavily impacted by unforeseen global events that drastically reduce bookings mid-year. They would find this invaluable for getting back cash paid based on earlier forecasts. It's also incredibly useful for businesses with highly variable income streams, like, say, construction companies, where project timelines and profits can fluctuate wildly from quarter to quarter due to delays or contract changes. And importantly, it's also a tool for situations where a major tax credit is expected later in the year, perhaps due to significant R&D expenditures kicking in, or large investments in energy-efficient equipment qualifying for credits, or other qualifying activities. These situations often lead to substantial overpayments in earlier quarters before those credits are fully factored in and realized. This form allows companies to get that capital back into play much sooner than waiting for the final return.
So it's interesting. It's not just about recovering from bad news, like an unexpected downturn, but also about proactively managing the positive financial impact of good news, like a big tax credit that you maybe weren't able to fully factor in early enough. This form really seems to foster proactive, agile tax planning, doesn't it?
Absolutely. To truly utilize Form 4466 effectively, corporations are really encouraged to move beyond just doing the minimum quarterly estimated payment calculations. Instead, they should regularly review their estimated tax payments against their current financial performance and their updated forecasts. This form essentially pushes businesses to maintain accurate and dynamic financial forecasts throughout the entire year, rather than just waiting until year-end to reconcile everything. This ongoing vigilance can help highlight potential overpayments much sooner, allowing you to act on them faster using Form 4466. It could even become a regular checkpoint in a company's financial calendar, maybe after the Q2 or Q3 financial results are finalized and the year-end picture becomes clearer.
And how does this connect to overall corporate health? We're talking about more than just tax compliance here. We're talking about the fundamental well-being of the company, its agility, its resilience.
Precisely. Efficient tax management, which includes the swift recovery of overpayments via Form 4466, directly contributes to a healthier balance sheet and can improve key financial ratios. Think about it. An immediate cash infusion can dramatically improve liquidity ratios, like the current ratio or quick ratio. It reduces reliance on external borrowing, which lowers debt ratios. And it frees up internal resources that can then be redirected towards core business objectives, growth, innovation, efficiency improvements. This understanding can directly translate into freeing up capital for those objectives, or maybe just building a stronger financial cushion against future uncertainties or economic downturns. It helps companies be more agile and resilient in volatile markets, allowing them to perhaps pivot more quickly or invest strategically when competitors might be financially constrained. In that sense, it can be a real competitive advantage.
It really does sound like it should be part of every corporation's strategic financial toolkit, a key component of robust cash management. And given the complexities, especially around calculating that expected tax liability accurately on line 4, and the very real risk of that severe, non-deductible excessive refund penalty. I imagine the role of qualified professionals, tax advisors, accountants is pretty critical here. This doesn't really sound like a do-it-yourself project for most complex companies.
Oh, without a doubt. We would strongly advise consulting with a qualified tax advisor or accountant. Their expertise is truly invaluable for ensuring accurate calculations, proper compliance with all the rules, and correct filing procedures. They don't just, fill out the form, they help with the rigorous forecasting that's needed for line 4. They can help assess eligibility, especially across complex corporate structures like affiliated groups filing consolidated returns. And crucially, they help you navigate the process to avoid that costly non-deductible penalty. A skilled professional can really help you understand the nuances specific to your corporate structure and your industry, ensuring you maximize the benefit of this quick refund mechanism while minimizing any potential risks. It's generally an investment that pays for itself many times over just by getting that cash back faster and avoiding penalties.
So what does this all mean for you, the listener, managing corporate finances? Form 4466 is a powerful yet maybe often underutilized tool for corporations to quickly recover overpaid estimated taxes. It's really about more than just getting money back eventually. It's about optimizing your company's cash flow now, putting those funds to work faster, and significantly enhancing your financial agility. It's about reclaiming your own capital and putting it back to work for your business instead of letting it sit idle with the IRS for months.
Yeah, it's about understanding that these tax forms aren't just compliance hurdles you have to jump over. Some of them, like this one, are potential pathways to significant financial advantage if you know how to use them strategically.
So consider this as we wrap up. If this single form, Form 4466, focused just on estimated tax overpayments, can potentially unlock significant cash and improve your company's liquidity in a matter of weeks, what other seemingly niche tax provisions or maybe financial mechanisms might be quietly waiting out there to empower your business? The deep dive into these kinds of details isn't just about ticking compliance boxes, it's really about uncovering hidden opportunities for financial strength and strategic growth. What else might you be leaving on the table simply because you haven't looked closely enough?